Welcome to The Explainer. Today, we are cracking open IFRS 13. The absolute main objective here is to define fair value, set out a single IFRS framework for measuring it, and dictate the required disclosures. Essentially, it applies explicitly anytime another standard requires or permits a fair value measurement. And just to be totally clear on the definition, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Keep in mind, this standard is explicitly out of scope for share-based payment transactions under IFRS 2 and leasing transactions under IFRS 16.
So, that brings us to the million-dollar question. What is an asset actually worth in the real world? Answering that relies incredibly heavily on professional judgment and structured models. Because, let's face it, observable market prices aren't always just sitting there waiting for us. This inherently introduces a massive area of what we call estimation uncertainty. This uncertainty is completely driven by the variability in selecting the right valuation techniques, forecasting future cash flows, and nailing down the exact risk premiums that market participants would demand.
To properly apply this framework, you need to recognize when all of the following criteria are met. It's a simple checklist. Number 1, a specific asset or liability is identified. Number 2, a hypothetical transaction is assumed to actually take place. And number 3, market participants are acting in their own economic best interest. So, if an asset or liability meets the recognition criteria of whatever referencing standard you're using, then you measure it using this specific fair value framework. And on the flip side, if an entity settles a liability or sells an asset, then derecognition criteria apply based entirely on the exit price realized on that measurement date. All right, we've got 6 key areas to hit. 1, defining fair value. 2, the market participant perspective. 3, measuring assets and liabilities. 4, entry price versus exit price. 5, the impact on financial instruments. And 6, the broader IFRS landscape. These topics, which also include valuation techniques, the fair value hierarchy, and required disclosures, are drawn right from the standard. Consider this your master checklist for practice to ensure literally nothing slips through the cracks. Okay, Section 1. Let's really lock down the core concepts of defining fair value. The golden rule you have to remember is that the measurement basis is strictly market-centric, not entity-specific. What is included are the assumptions that market participants would actually use when pricing the asset or liability. And yes, that includes assumptions about risk. What is absolutely excluded are your own entity-specific intentions to hold an asset or settle a liability. For example, if a manufacturer buys a patent for a brand new engine design, the fair value measurement has to include the open market's pricing for that technology. You have to completely exclude the manufacturer's internal intent to just shelve the patent to protect its older legacy products. The market doesn't care about your internal strategy. Moving right into Section 2, the market participant perspective.
The measurement always assumes a transaction is happening in the principal market, which is simply the market with the greatest volume and level of activity for that specific item. We assume the buyers and sellers are knowledgeable, able, and willing. Now listen closely to these rules. Except when parties are related, you must assume they are totally independent. If related parties are involved, using that transaction price as a fair value proxy is strictly prohibited, unless it can be rigorously proven the transaction was executed at arm's length. Furthermore, you shall not adjust the price for transaction costs to determine the fair value. Transaction costs are a characteristic of the transaction itself, not the underlying asset.
Up next is Section 3, measuring assets and liabilities. Let's get into the mechanics.
When we talk about subsequent measurement, you have to apply specific valuation techniques, namely the market, cost, or income approaches. And IFRS 13 establishes a very strict fair value hierarchy here. If you have unadjusted quoted prices in active markets, then you absolutely must use these Level 1 inputs. If Level 1 is unavailable, then you drop down and use observable Level 2 inputs. If observable data is entirely lacking, then you're forced to use unobservable Level 3 inputs. Now, where do these changes in fair value ultimately land? Whether they go to profit or loss or other comprehensive income depends entirely on the referencing standard, not IFRS 13. For non-financial assets, measuring based on their highest and best use is mandatory. However, choosing between the market, cost, or income approach for a specific class of assets often represents a distinct policy choice, which is going to produce entirely different measurement models based on what inputs you have available.
Section 4, entry versus exit price. This is where a lot of confusion happens.
Let's highlight one of the most frequent application errors practitioners make.
Mistake number 1, assuming the entry price automatically equals the exit price at initial recognition. The mistake is just defaulting to the transaction price you paid and calling it fair value. The correct treatment dictates that fair value is always the exit price, the price you'd receive to sell the asset today. So if you buy an asset in a retail market but you'd have to sell it in a wholesale market, then the exit price is going to instantly differ from your entry price on day 1, and you must recognize that day 1 difference.
On to Section 5. Let's look at the actual impact on financial instruments, especially regarding IFRS 9.
Let's look at the interaction with IFRS 9. The hierarchy here is simple. IFRS 9 dictates when to measure at fair value, but IFRS 13 dictates how. For example, if a bank issues a mortgage loan and funds it with a matching bond, and then the bond's credit risk worsens, then both fair values drop. But where does this impact go? If those contractually linked changes were routed to other comprehensive income, then you've just created a massive accounting mismatch in your P&L. Therefore, IFRS 9 steps in and requires these specific linked fair value changes to flow directly through profit or loss.
Section 6. The broader landscape. Let's see how this universally applies. Consider the interaction with IAS 10, events after the reporting period, which guides how we treat fair value changes after the measurement date. If a material decline in fair value happens after the reporting period, then it is firmly a non-adjusting event. Why? Because the fair value is already correctly measured at that specific measurement date. The market just moved afterward. This perfectly triggers our disclosure requirements. If a material non-adjusting event occurs, then qualitative and quantitative disclosures are absolutely required in the notes. Specifically, you have to disclose the nature of the event and an estimate of its financial effect, or you have to provide a qualitative statement saying that an estimate just cannot be made.
Let's rattle through a few more standard interactions where IFRS 13 is the underlying engine. Under IFRS 3 business combinations, IFRS 13 is used to measure the fair value of identifiable assets acquired and liabilities assumed. Under IAS 36, impairment of assets, it dictates exactly how to calculate fair value less costs of disposal for recoverable amounts. And for IAS 40 investment property, an entity can actually elect to measure investment property at fair value. Selecting that fair value model under IAS 40 is a major policy choice, which will produce ongoing fair value adjustments flowing directly into profit or loss, rather than just relying on historical cost appreciation.
Before we finish up, let's address 2 more frequent application mistakes. Error number 2, failing to continuously update Level 3 unobservable inputs. Practitioners constantly make the mistake of just rolling forward historical assumptions without ever verifying if the market participants' views have actually shifted. The correct treatment requires aggressively reassessing those unobservable inputs at every single measurement date. Error number 3, inappropriately incorporating entity-specific synergies into your highest invest use calculations. The mistake here is inflating an asset's fair value based on unique cost savings that only your specific firm can achieve. The correct treatment strictly restricts synergies to only those that would be available to any typical market participant.
So the next time you sit down to measure fair value, ask yourself, are your unobservable inputs truly reflecting market reality, or are you just creating a fictional market in your head to match your balance sheet goals? Getting this right involves incredibly high levels of estimation uncertainty. Even a minor tweak to a discount rate or a cash flow projection can dramatically alter the balance sheet and completely misrepresent financial health. You have to respect the hierarchy, rigidly document your assumptions, and always ensure your measurement genuinely reflects the exit price as determined by the market, not just by you.